My neighbor Linda retired last year at 63, had about $450,000 in her traditional 401k. Felt pretty good about it. Then her tax guy calls her in December, says, "We need to talk about your taxes for next year." She's thinking, "What taxes? I'm retired. I barely made any money this year." He says, "Linda, when you turn 73, the government's going to force you to start pulling money out of that 401k, and they're going to tax every dollar of it. Based on your balance, you're looking at about $25,000 a year in withdrawals. That's going to push you into a higher tax bracket, make your Social Security taxable, and might even increase your Medicare premiums." Linda just sits there. "So what do I do?" He says, "We convert some of it to a Roth now, before you're forced to take it out." She'd never heard of this, and neither have most people. So let's talk about it. Because if you're between 60 and 73 and you've got money in a traditional IRA or 401k, this might be the smartest tax move you never knew existed. Pull up a chair. Okay, so first, let me explain what a Roth conversion actually is, because the name sounds complicated, but the concept isn't. You've got money in a traditional retirement account, 401k, traditional IRA, whatever. That money's never been taxed. You got a tax deduction when you put it in. But when you take it out, you pay ordinary income tax on every dollar. A Roth IRA works the opposite way. You put money in after tax, but when you take it out in retirement, tax-free. No taxes on the growth, no taxes on the withdrawals, nothing. A Roth conversion is when you move money from your traditional account into a Roth account. You pay the taxes now up front, and then it grows tax-free forever. Why would you do this? Because there are situations where paying taxes now cost you way less than paying taxes later. And for a lot of retirees, the years between 60 and 73 are the lowest tax years they'll ever have again. Let me show you why. Here's what happens at 73 that most people don't see coming. The IRS forces you to start taking money out of your traditional retirement accounts. It's called an RMD, Required Minimum Distribution. You don't get a choice. They calculate how much you have to take out based on your age and account balance, and you have to withdraw it, and you have to pay taxes on it. At 73, your first RMD is about 3.8% of your account balance. So if you've got $500,000 in your 401k at 73, you're forced to pull out about $19,000 that year, whether you need it or not. At 75, it's 4.1%. At 80, it's 5.3%. At 85, it's 6.8%. The older you get, the bigger the percentage, because the IRS assumes you're going to die eventually, and they want their tax money before that happens. Here's the problem. That forced withdrawal might push you into a higher tax bracket. Let's say you're a single filer. You're taking Social Security, about $24,000 a year. You've got a small pension, another $12,000. That's $36,000 in income. At that level, you're in the 12% tax bracket. Life's pretty good. Then RMDs kick in. Now you're forced to take another $19,000 from your 401k. Your income just jumped to $55,000. Now you're in the 22% bracket. Plus, more of your Social Security becomes taxable. Plus, your Medicare Part B premium might go up because they base it on your income from 2 years earlier. So you're paying more in income tax, more in Social Security, and more for Medicare. All because the government forced you to take money you didn't even need. And here's the kicker. Your RMDs get bigger every year, so this problem gets worse as you age. By the time you're 85, you might be forced to pull out $40,000 a year, maybe more, and you're paying tax on all of it. So here's where the Roth conversion comes in. Let's say you retire at 62. Social Security doesn't start until 67. You're living off savings for those 5 years. Your taxable income during those years, basically zero or very low. This is your window. You can convert chunks of your traditional IRA or 401k to a Roth, pay taxes on it at a low rate, and get it out of the traditional account before RMDs start. Here's how Linda's doing it. Linda retired at 63. She's got $450,000 in her traditional 401k. She's not taking Social Security yet. She's living off cash savings for now. Her income this year? About $8,000 from some dividends. That's it. So her tax guy says, let's convert $40,000 from her 401k to a Roth. $40,000 plus her $8,000 in dividends equals $48,000 in income for the year. For a single filer, the 12% bracket goes up to about $47,000, so she's right at the edge. She'll pay about $4,800 in federal tax on that $40,000 conversion, 12%. That $40,000 is now in her Roth. It'll grow tax-free, and when she takes it out in 20 years, she pays zero tax on it. Compare that to what happens if she doesn't convert. At 73, that $40,000 is still in her traditional 401k. Let's say it's grown to $60,000 by then. Her RMD forces her to take some of it out, but now she's also getting Social Security and a pension. Her income's higher. She's in the 22% bracket, maybe even the 24% bracket. She pays 50% more in taxes on the same money just because she waited. By converting now while her income's low, she's saving thousands. And here's the best part. She can do this every year until Social Security kicks in. Year 1, convert $40,000. Year 2, convert another $40,000. Year 3, another $40,000. By the time she's 67 and starts Social Security, she's moved $120,000 into her Roth, and her traditional 401k balance is way lower. So when RMDs start at 73, they're smaller. She's in a lower tax bracket, Medicare premiums stay low. She has basically hacked the tax code. Okay, so who should actually consider a Roth conversion? You're a good candidate if, 1, you're retired but not taking Social Security yet. This is the sweet spot. Your income's low, you've got room in the lower tax brackets, convert while it's cheap. 2, you've got a big traditional IRA or 401k balance. If you've got $300,000 or more, your RMDs are going to be significant. Moving some of it to a Roth now saves you later. 3, you don't need all your retirement savings to live on. If you're pulling out every dollar just to pay bills, you can't afford to pay the conversion tax. But if you've got other income or savings to live on, you've got flexibility. 4, you've got cash outside of retirement accounts to pay the tax. This is important. When you convert, you owe taxes. You want to pay that tax from a regular savings account, not from the retirement account itself. If you convert $40,000 and pay the $4,800 tax bill from the 401k, you just lost $4,800 of future growth. Pay it from savings if you can. You should probably skip this if, 1, you're still working and making good income. If you're already in the 22 or 24% bracket, converting just adds more income at a high rate. Wait until you retire. 2, you're going to be in a lower bracket in retirement anyway. If you're in the 24% bracket now and you'll be in the 12% bracket in retirement, don't convert. Just wait and pay the lower rate later. 3, you need every dollar of your retirement money. Conversions cost money up front. If you're barely getting by, this isn't the move. Let me show you the actual math on what this saves. Scenario 1, no conversions. You retire at 62 with $500,000 in a traditional IRA. You don't touch it. It grows at 6% per year. At 73, it's worth about $900,000. Your first RMD is about $34,000. You're in the 22% bracket. You pay $7,500 in federal tax that year. Over the next 15 years, you're forced to take out about $600,000. You pay about $130,000 in taxes on it. Scenario 2, you do Roth conversions. Same $500,000 starting balance, but from age 62 to 67, you convert $50,000 a year into a Roth. You pay 12% tax on each conversion, $6,000 per year, $30,000 total over 5 years. You've moved $250,000 into the Roth. The other $250,000 stays in the traditional IRA and grows. At 73, your traditional IRA is worth about $450,000. Your Roth is worth about $375,000. Your RMD on $450,000 is only $17,000. You're in the 12% bracket. You pay $2,000 in tax. Over 15 years, you take out about $300,000 from the traditional IRA. You pay about $36,000 in taxes. Plus, you take another $300,000 from your Roth, tax-free. Total taxes paid? Scenario 1, $130,000. Scenario 2, $66,000. $30,000 in conversions plus $36,000 in RMDs. You saved $64,000 just by being strategic about when you paid the tax.
Now here's something smart people are doing. You get excited. You want to move it all to a Roth, so you convert $200,000 in 1 year. Congratulations. You just pushed yourself into the 32 or 37% bracket. You paid way more tax than you needed to. Do it slowly. Convert just enough to stay in the 12% bracket, or the 22% bracket if that's where you are. Don't spike your income. Mistake 2, not having cash to pay the tax. You convert $50,000, you owe $6,000 in taxes, but you don't have $6,000 in cash, so you take it from the $50,000. Now you've only got $44,000 in the Roth, and you lost $6,000 of future growth. Always pay the conversion tax from outside the retirement account. Mistake 3, doing it too late. You wait until 70 to start converting. You've only got 3 years before RMDs start. You can't move enough money fast enough. The earlier you start, the more you can move. Look, I'm not saying everyone should do a Roth conversion. It's not a one-size-fits-all thing. But if you're in that window between retiring and starting RMDs, it's worth looking at. Because here's the thing. The tax code is designed to extract maximum money from you in your 70s and 80s. RMDs are the government saying, okay, time's up, we want our cut. A Roth conversion lets you pay the tax on your terms, when your income's low, when the rate's cheaper. It's one of the few times you actually get to outsmart the system legally. So here's what you do this week. 1, look at your tax return from last year. What bracket are you in? 2, if you're retired and in the 10 or 12% bracket, call a tax person, ask about Roth conversions. 3, run the numbers, see how much you can convert without jumping into the next bracket. This isn't something you wing. You want a professional running the math, but it's worth the conversation. All right, that's it from the porch today. Next time, we're talking about the 3 income streams every retiree needs, because relying on just Social Security is like sitting on a one-legged stool. See you then.